Good evening. Tonight is Tuesday, October 23rd. I'm gonna talk about dividends, and just dividend policy. So, in terms of announcements, well, you just received your midterm. The multiple choice is probably in WebCT, but when the Scantron people put it on in WebCT, I actually have to go in and turn it on so you can see it. But you should have seen on the cover page of your midterm what your multiple choice result was. So the midterms are out. If you were late, you didn't get your midterm, you can look at the pile at the first break. In terms of announcements going forward, Quiz 3 is next Tuesday. Same format as before. It's in the class in the first half hour of the class. It's only on chapter 17, so it's going to be the by far the easiest quiz of the course, just because of the way that the classes are ordered, and the fact that I need to I can't have any quizzes in class within the last 2 weeks. So I gotta have quiz 4 the third last week, and then I didn't want to do them back to back, even though you end up now with a midterm and then a quiz back to back. But that's the best way I could set up the schedule. So next Tuesday, October 30th, like I said already, only on chapter 17, which is what I'm covering tonight. So I'm the TA is if you're here, you probably don't care that much about videos, but anyway, the video is going to be available by sometimes tomorrow night. Suggested exercises. Who here is using suggested exercises? Please say we didn't waste our time making all of those because it was quite a bit of work. So that's one of the best ways to study, is to look at. This is kind of what you would call a recipes course. You know, I got this problem, I do it like this. I got this other problem, I do it like this. So it's not so much, you know, read chapters and chapters and chapters and memorize. It's more just learn by doing. It's just practice. Know how to do the different problem types, and then it goes pretty easy. And the best way is the suggested exercises. There's lots of them. You have the full written solutions, and you can also use the if you look at the examples in class, you can try to redo those, and then you have the solutions in the notes. The textbook, in case you don't have it, I put mine in the library, so you can just go photocopy the problems at the end of the chapter. Really, that's really the obviously a lot of the slides that I started with before, you know, 5-6 years of polishing them over and over again. But the slides I started with are based on the textbook. So, but in terms of, you know, the chapters, you get just as much by being in the class than you do reading the chapters, even though it helps to read, you know, because sometimes the book explains a slightly different style than me, so maybe you understand more from the book. People say it both ways, you know. Textbooks suck, the prof is good, or the prof is bad, and the textbook's right. So, you know, some people learn different ways. So you have lots and lots of different resources. Whatever works best for you, continue doing it. Like I said, video is going to be available probably tomorrow. It just takes a lot of time after you upload it to YouTube to, like, it's called rendering, I think. So in chapter 17, talk about the different types of dividends and how does a dividend policy for a corporation works. It's actually quite important because when you own a stock, that's the way that you get paid. Right? The company makes money, and it pays out part of that. It uses part of that money to reinvest in itself, but then uses part of that money to pay back the people that invested in that company in the first place. So that's the way when you're a shareholder of a company, dividends are the way you get paid. So if you look at the different cash flows, you have internal cash flow, which would be your operating cash flow minus the net capital spending. So whatever new equipment you buy minus the money that you get from selling used equipment, and then you also have whatever cash you gotta put back into net working capital. So it could be, if you're a retail store and you're growing your square footage, you're going to need more inventory. If you're a company that does credit sales like Net 30 and your sales are growing, therefore you will have your account receivables will grow at the same time, so you'll have more cash tied up in that. But in general, that's what we call internal cash flow. And you can also get cash flow from either creditors or shareholders. So that's your cash flow. Then what do you do with it? You can do these, new investments, the acquisitions. You can reinvest in existing operation. This picture is similar to Chapter 2. It's just slightly, it's organized a little bit different. It's more the inflow and the outflows as opposed to operating, investing, and financing activities. Stock repurchases and cash dividends are two ways to return cash to shareholders. In the U.S., historically, there was a difference in the taxation of dividends versus the taxation of capital gains. So investors would prefer stock repurchases. The way that a stock repurchase works is, if I have, say I have $1,000 to that I want to give back to the shareholders. I can either do a dividend, but what I can do is go out in the market, buy a certain amount of shares, and so what that does is it reduces the amount of shares outstanding, and therefore for the same amount of earnings, you have a higher earnings per share, and therefore the value. If, for example, I'm making $1 million a year, and I have 1 million shares out there, if I go out and I buy half of those shares, say at 500,000, then what happens is now that same amount of earnings is spread over less shares, so the shares are out there are worth a lot more. That's how a stock repurchase returns money to shareholder. It reduces the amount of shares out there, and therefore each share is worth more because it has a higher amount of earnings. If you reduce the amount of shares but the earnings stay flat, you have more earnings per share, and therefore that creates a capital gain, which is taxed historically in the U.S. much more favorably than a dividend. And that's why, especially in the U.S. market, you'll see a lot more share buybacks than you see dividends from companies. Has to do with taxation. Different types of dividends. Regular cash dividend. That's companies that, especially mature companies, that have a pretty good, feeling how much money they're going to make from year to year. If you're Procter & Gamble and you're selling diapers, there's a certain amount of babies out there, and you're always going to, it's not like from one quarter to the next you're going to sell double or no diapers. Those are, there's some businesses that are very, stable cash flow businesses. So you can say we will pay, 50 cents, $1 per share dividend each quarter, or so that's a regular cash dividend. That's what's obviously most common. Extra cash dividend. That's in the textbook. It's called extra cash dividend, but usually in the market, it's called a special dividend. This is when you have a one-time event where the company ends up with a big amount of cash, or there's just cash that's been piled up over time. A good example, I think, was Microsoft a couple years ago. They had a regular dividend, but the cash was piling up, and they didn't really have anything to reinvest in. So just a one-time, usually they would be paying, I don't know, like 20 cents a share per quarter, but all of a sudden they just like, oh, here's like $1.15 or something. But they made it clear that, look, we're giving you $1.15. That's, I don't know, like $2-3 billion worth of cash. But that's not something we're going to keep doing. It's just a one-time thing, a special dividend. Another reason why you might see a special dividend happen is when a company sells part of its operation. So you might have what's called a divestiture. So you might have a company that has, many different businesses, and they sell one part. They get a bunch of money, and then instead of just keeping that money in their bank account, they just declare whatever the gain from that divestiture would be as a special dividend, a one-time thing. There's other reasons, but those are mostly the ones I can think of. These one-time events, there can be a couple of different ones, but those are the more common. A liquidating dividend is when a company is closed down. Now, usually when a company is closed down, it's through bankruptcy, and there's not enough money to pay even all the creditors, so there's nothing left for the shareholders. So liquidating dividend, I would say, is extremely rare, because that's a company that's going, closing the business on purpose, but that's doing well enough that they have more money and in the bank and more assets than the liabilities. Because what happens, the way that the legal structure of a company works, is if a company closed down, is liquidated, you take all the assets, you liquidate them all, so convert them all to cash, and then you got to pay all the creditors, so bank loans and bonds and any interest payments that have accrued, and then whatever is left after that is split evenly between the shareholder based on how many share each shareholder has. Cash dividends reduce cash and retained earnings. Basically, the way to think of a cash dividend is as an outflow from retained earnings. When you have retained earnings, if you look at financial statements, you're going to have retained earnings less dividend declared, and then basically the common stock account plus retained earnings less the dividend gives you what the equity is. Just a simple example of dividend per share. In this example, I introduced the concept of the retention ratio, and there's also the payout ratio. What those things are is you make a certain amount of money, and then you say, we're going to pay out half of what we make, or we're going to retain a quarter of the money that we make, and then we're going to pay out the rest. So this is a dividend policy that's based on, it's not a fixed, we're going to pay the same amount each quarter or each month or each year. It's whatever we make, we have a declared percentage of this is what, we're going to give. In this case, the retention ratio is 70%, meaning that the payout ratio is 30%. So if you keep 70% of the income, then 30% gets paid out as dividends. So in this case, dividend per share is going to be the dividends divided by how many shares you have. That's going to be the net income times the payout ratio. So the payout ratio is the percentage of net income that you're going to pay out in dividends. But it's given as a retention ratio. And so in this case, the net income is $155,000. So if you retain 70% of your income, then you're going to pay out 30% of 155,000, and then that's over 31,000 shares. So you're paying out $1.50 a share in dividends. Okay, now let's talk about how does the actual mechanism of a dividend payment work. Because think of especially if you're a big company. If you're a private company, you know the number of shareholders and who owns shares changes very rarely, if ever. If you're a public company, your shares are traded on an exchange every day. So when you say I pay a dividend, who do I pay it to? This is the mechanism for a dividend payment. So first, the board of directors declares a dividend. So what they'll say is, we will pay on Monday, February 16, a dividend of, say, like that example, $1.50 to shareholders of record on January 30th. What that means is shareholders of record, which is called the record date, you're going to look on that day, 2 days at the close of business, 2 days before, who are the shareholders. Because it takes time for things to settle between. It's not like at the end of the shares trade all day long, say in Toronto, until 4 o'clock, and then at 4:01 you can't say, give me a printout of who owns shares now. It takes you have these things called clearing times, and so the way that it works, at least in Canada, is there's a record date, and then you look at on that date you look 2 days ago. So by that time, all the back office stuff, all the paperwork, well, it's not paperwork, all the electronic stuff is done. And so on the 30th, you look at 2 days before, on January 28th, at the end of the business day, who owns shares, and then these are the people that you send payments to. So they'll receive the payment on the 16th, and that's the way it works. So, and the reason why it's called the ex-dividend date is because up to that day, if you own the shares, you receive the dividend. If you bought the shares after that day, then you don't. So it could be you have a person that owned the shares up until they sold them on January 29th. So when the checks are mailed, well, the electronic transfers are done, they don't own the shares anymore, but they receive that dividend payment because at the time that people said we're going to pay the dividend based on who owns it on that day, they owned it. If somebody instead bought the shares on the sold the share. If somebody sold the shares on the 27th, then, if somebody bought them on the 27th, then they would not. It goes ex-dividend on the 28th. Yeah. If somebody buys it on the Thursday, which is the 29th, then you don't have the dividend attached to the shares. So when you look at the share over time, you say that on the 27, on the 20, on the 26, on the 27, on the 28, the dividend is attached to the share, and after that, it's not. That's why it's called the ex-dividend date. The dividend is not attached to the share anymore. There you go. That's just what I just said in text form. And that's important. The ex-dividend date, 2 business days before the date of record. So if I said the date of record was a Monday, then it would be whoever had the shares at close of business the Thursday before that. And an important point is that the value of that stock drops by exactly the amount of the dividend on that day. Yeah.
Is it allowed to short stocks just at these dates?
When you short a stock, you have to pay the dividend to the person you're shorting it to. So if I short a stock and there's a dividend payment, the money because when you're shorting a stock, you have a margin account. So if you short a stock and then there's a dividend payment, you have to pay the dividend.
So the broker takes the money from the game and give it to the margin.
No, it would be in your. It would be taken out of your margin account and then sent to the clearinghouse. Obviously, it says there, date of payment checks are mailed. No, textbook's pretty old. It's not done by mail anymore. So you can see you have a stock that's worth $10. So on the X, and you have a dividend that's of $1 that's declared. So the stock drops by exactly the value of the shares because of the fact that if you own the share before the X date, you receive that dollar. But if you own the share after that X date, you don't. Therefore, the share drops by exactly the amount of that dividend. Now, let's look at the dividend timing. On January 2nd, the board of directors declared a dividend of 75 cents, payable on Monday to shareholders of record on Monday, January 14. If you bought 500 shares of DDD stock on Friday, January 4th, how much will you receive in dividend? This type of question is all about recognizing, did the person buy the share before or after the ex-dividend date? So if the record date is Monday, January 14, then the ex-dividend date would be Thursday, 13, 12, 11, 10, would be Thursday, January 10th. And so if you bought the stock on January 4th, then you would receive the dividend. So in this case, so the dividend you receive is the number of shares you have times what the dividend per share was. You own 500 shares. Now this next example, like I said, it's all about figuring out, are you getting the dividend or not based on the day that you bought it. So in this case, you bought the 500 shares of DDD stock on Friday, January 11th. But the shareholders of record was, the record date was Monday, January 14. Therefore, the ex-dividend date, if the record date was Monday, then the ex-dividend date would have been the Thursday before. So since you bought them on Friday, which is one day too late, if you would have bought it on Thursday, January 10th, you would have received the dividend. But because you bought the shares on Friday instead, then you don't receive the dividend. Therefore, the answer is 0. The person, yeah, go ahead.
Is it always Thursday or like the
No, just it's now. I don't know what it's like in other countries.
Friday,
It's exactly 2 business days before. So maybe if you say the record date is a Wednesday, then it's whoever the person that owned the shares on the Monday would have been. It's 2 business days, but obviously if the record date is a Monday, you got to back up over the weekend. Yeah, if the record date is Monday, then 2 business days before is the Thursday, right? The Friday is 1 business day before, and the Thursday is 2 business days before. Okay, now what we're going to talk about is dividend policy. What dividend policy is, it's a statement, or it's a way that the board of directors decide on what the dividends are going to be. So does it matter? The value of the stock is based, you should know that by now, on the present value of expected future dividends. Dividend policy might not matter because of this reason. If a company, instead of paying the cash out as dividend, takes the money and reinvests in a business to grow the business, then the share's going to be worth more. What happens is, the question there from the point of view of an investor is, am I able to reinvest that money at a higher rate than the company can reinvest in itself? But from the point of view of the company, the actual policy that you use might not matter, because I think it's the next slide. Well, there's irrelevance, but I'm going to talk, it's in a couple slides from now, what's called the clientele effect. If you switch from being a low dividend paying company to a high dividend paying company, then what you're going to do is attract different types of investors. There's either investors that look for capital gains over the very long term. So those people would prefer that you take the money and reinvest and grow the company so it does a lot better in the future. Whereas some other investors are more concerned about, for example, people that are in retirement, they're more concerned about the income that they receive today. So then those people would prefer to receive the dividend today than to have to wait 5-10 years for the company to grow and then be worth more. Let's look at what's called irrelevance. So if you have a firm that can either pay out $10,000 per year for each of the next 2 years, or $9,000 in 1 year, reinvest that $1,000 to make $11,120 in year 2 instead. Investors require a 12% return. So if you look at what is the value of those two stocks? What is the value, or those two scenarios? So if you discount 10,000 for 1 year at 12% and 10,000 at 12% for 2 years, you get 16,900. But if you only receive 9,000 instead of 10,000, and then because the company takes the 1,000 that they didn't pay out, and they reinvest to grow the business, and then they make more money in the second year, so they end up making, they pay out 1,000 less in year 1, but using that extra 1,000, they end up making 11,120 in year 2. Then what happens is the value to the investor of those two scenarios is actually the same. Why? It's because in this case, the company was able to reinvest in itself at the same rate as that. Yeah.
This only holds though if we're assuming that the investor can generate the same amount of return that a company can.
No, this holds here where we're looking at the company itself. The company itself can, by reinvesting in itself, that retained earnings investment earns the same return as the people are putting as the required return on that stock. Right? You can see right now we're discounting the future dividends at 12%, but the company took that 1,000 that they retained and they invested it, and it gave them a 12% return. Therefore, those two outcomes are even. When a company can reinvest in itself at a higher return than the market is giving as a required return on their stock, then they're better to do that. And vice versa, if the required return on a stock is very low, but the company is able to, if the required return on the stock is very high, but the company is not able to invest at that higher return, then they're better to pay it out. But when the company reinvests in itself and they're able to achieve the same rate of return as the required return that investors put on that stock, then it doesn't make any difference whether you pay it out or not. Yeah. It says it there on that bottom sentence. If the company will earn the required return, then it doesn't matter when it pays the dividend. Just like we had homemade leverage in chapter 16, you have a similar concept when it comes to dividends. remember that in Chapter 16, if you owned a stock that had a different amount of debt or a different amount of leverage, same thing, that what you could do is, if you want to increase the leverage, you could borrow and then buy shares with it. So you could create a synthetic portfolio from the point of view of the investor, hence the word homemade, that had more debt than the company itself. And vice versa, you could, if a company had too much debt, what you could do is sell some of the company's shares and then invest that cash that you receive into, if you were able to invest it in the debt of that company, you would actually effectively reduce the amount of leverage from the point of view of the investor. You have a similar concept when it comes to dividends. If you want to receive dividend but the company is not, then what you do is you just take some of the shares that you own and you sell them, and then you keep that cash. So that's say I own I don't know 100,000 shares of a company, but the company is not paying any dividends at all. But I want to, I'm retired or I don't feel like working, so I need to have an income each year to live. What do? Every year I take a little bit of the shares that I own and I sell them. And that creates, from the point of view of my portfolio, that creates a synthetic dividend. That's the idea of a homemade dividend. So let's see. And vice versa, if you own a company and you really like that company and you want to continue investing in it, but the company is paying out more in dividend than you want to receive, you don't need the income, it's more of a long-term investment, then what you do is you take the dividends that you receive and you buy more shares. This is what's called dividend reinvestment plans. So a lot of you, if you have an RSP set up, whenever, and a lot of mutual funds do that, whenever companies pay out dividends, instead of just putting cash in your account and having the cash pile up, any dividends that are paid out automatically get reinvested into new shares of the company. So you could basically, if a company's paying dividends when you don't want, or vice versa, you can take these actions to create a homemade portfolio. Yep. Sorry? Yeah, so it's obviously some of these concepts are a little distorted through taxes, so you might have to sell a little more, a little less to create the exact same cash flow that you're looking for. But the concept is, it's more from the point of view of, there's a company that's not paying a dividend, but I need income. Yeah, it's gonna, see, when you have an RSP, the dividends are staying inside, so you receive the dividend and you buy more shares, because they're inside that tax, what do they call it? Tax shelter, tax deferred, I think, or whatever. You don't actually, when the company pays the dividend, you receive the cash and then you take that cash and you buy more shares. Because it's inside this investment account, it doesn't, this retirement thing, it doesn't actually nail you with taxes each year when the dividend comes out. But yeah, taxes can skew a little bit what's going on here, that's for sure. Okay, let's see, do I have an example of a homemade dividend? So Priscilla owns 500 shares of Delta stock. The company issued a statement that it will pay $1 per share dividend this year and a 50-cent per share dividend next year. Priscilla does not want any dividend this year, but wants as much dividend income next year. So her required return on the stock is 12%. Ignoring taxes, what will Priscilla a homemade dividend per share be next year? So what you do, And therefore, the homemade dividend for year 1, so 1 year forward, is going to be the dividend that you receive this year times the rate of return plus. So what happens is she takes the dividend that she gets this year, just puts it back in the stock that is returning 12%, and then next year she will have the value of that plus what she's going to receive next year. So the dividend this year is $1, and dividend next year is 50 cents. So she will receive a dividend of $1.62 next year. So I was talking about a little bit earlier this clientele and this low payout versus high payout. So why would you want a low dividend payout? If you're in a high or upper income tax bracket, you would prefer a lower dividend payment so that you wouldn't have to pay taxes now, but you would have higher capital gains in the future. And on capital gains, you only pay half of the return as opposed to the whole thing with dividends. Flotation costs. If a company needs to, this is a company that's growing and needs capital as it grows, then it's better for that company to, instead of having to pay a dividend and then need to have to issue new shares or new bonds to raise the capital for projects to grow the company. Remember from chapter 14 that there's flotation costs. You know, investment bankers don't work for nothing. And when you go and you raise shares, you sell shares or you sell bonds, you have to pay a certain percentage out as a fee and legal fees and all that stuff. So if a company is growing rapidly, it's easier to, instead of paying dividends on the shares that they have and have to raise new shares and pay those flotation costs, it's easier to just retain, to keep all that cash and then reinvest it in the company. There's also another reason why you might have a low payout is remember that dividends are paid to shareholders, but bondholders, creditors, have a higher precedence over the cash flow of the company. So sometimes in the covenants, right, the restrictions that are attached with debt, you might have that the company is not allowed to pay any dividends until all the interest has been paid out on the bonds. That's usually pretty straightforward. But there might be on top of that the company is not allowed to, has to keep a certain amount of cash or can only pay half of what it makes. Those are what are called restrictive covenants that would be on debt contracts. So you might say get a bank loan. A big company might get a bank loan, and as part of the legal contract for the company to get that loan, they'll say, well, we don't want you to end up paying too much dividend so that if you end up getting a bad month or a bad year, you don't have enough cash to pay or interest anymore. So what are alternatives to paying a dividend when you do have the cash? You can invest into additional capital budgeting projects. So basically you put money into all your everything, all the possible projects that you have until you run out of positive net present value projects. You can repurchase shares. That's an alternative to paying a dividend. It's two different ways of sending cash to back to shareholders. You can acquire other companies. So you can grow the business by acquisitions instead of organically. And then you can purchase financial assets. This is, I have I want to keep a certain amount of cash around because I ran out of positive net present value projects to invest in this year, but I'm thinking that next year, for example, an oil and gas company, I did a bunch of test wells this year and I didn't find anything, or I didn't find as much as I would have hoped, and so, but I did make money from the wells that are running already, and so I have this amount of cash. What do? Well, I can pay out as a dividend. I can buy another oil and gas company, or if once I've run out of things to invest in, but I expect that in the future I will need to invest in something, but it's just this year there's just nothing good to invest in, then what you do is you just park your money into typically a short term. So this is what you would call the marketable securities on the balance sheet of a company. A company might buy the debt of another company just to park the money, say, for like a year or two, because maybe I don't have anything good to invest in this year, but I'm expecting that in a year or two from now I'll have great things to invest in. And so instead of paying out all the cash out as dividends or repurchasing shares, and then next year or the year after having to go back to the market to raise new debt or new shares, I'm better to just park the money in financial assets that are highly liquid, and then when I need the money later, I can just get it back and then invest. Why would you want a high payout? Current income. If you're in a low tax bracket, for example, in the Canadian tax law, especially since the income has already been taxed at the corporate level, I think it's the first 30,000 of dividends are not taxable. But that depends if you have other income. But say if you have somebody in your family, like husband or wife or adult children that are not working. The reason why I say adult children is because there's something in the tax code called a kiddie tax that you can't split your income with children under 18 because then it's considered to be your income. But if you have a partner that's staying at home to raise children and you own a company, or you're investing into other companies, that person can receive, now the number changes every year, but it's roughly up to 30,000 in dividends without paying any tax at all. And after that, dividends are taxed at a lower rate than other income. And so, just in general, receiving dividends is one of the best ways to make money, at least in Canada. The tax system in the US is a little bit more screwed up, but if you're in a low tax bracket, receiving dividends is a great thing. Uncertainty resolution. This I would quote a RIM and maybe even Facebook there. If you
Is there more tax on dividend or capital gains?
In Canada, capital gains is lower than dividends, not by much, because capital gains are taxed at half the full rate, but dividends are taxed at less than the full rate. So there's slightly more for dividends than capital gains, but it's not a big difference. In a perfect world, in a fair and efficient tax system, there should be no difference because you wouldn't have these distorted thing where a company would decide to do one thing or the other because of taxes. Uncertainty resolution. Let's listen. Let's look at the story of Research in Motion. Right? Oh, they're growing forever. It's going so well, and yeah, they shouldn't pay any dividends because they got to take the money and invest it back in the R&D. And all of a sudden, the thing collapses. Well, if you had owned the shares of RIM over 5 or 10 years, if they would have paid a dividend over that time, then at least you would have gotten that money. A company that does not pay a dividend is essentially a long-term gamble because they're either going to make it really big or you're going to lose all your money, or at least a big part of your money. But by at least for sure that each year you are getting that dividend, then that reduces the amount of uncertainty about the amount what you're going to make on that investment, because you know each year that at least you made that much. So if say RIM would have paid a 5% dividend over 10 years, then at least the most you could have lost was half of your money instead of the whole thing. I think now they're down like 90% or something like that from the peak. So a company that takes all their money, does not pay any dividends at all, and reinvest in the business is a lot more risky, because you spend all these years holding on to an investment, and they are putting the money back in the company, and then at the end of the line they collapse. Well, boom, you just got nothing. If they would have paid the dividend along the way, then at least you would have had that in return, and it would have cushioned your blow. So that's a reason why you're much better to own dividend-paying stocks, because it reduces your long-term risk. Even if you're like 20 years old and you're investing in an RSP and I won't need that money until I'm like 60 or 70 years old, it's still a better investment to put money into dividend-paying stocks, because dividend-paying stocks, whenever there's a big shock like a crash, they fall down by a lot less than non-dividend paying stocks, because that amount of, whenever you have a stock market crash, or what's called a bear market where the market's going down, people like to go into safe stocks, and safe stocks are the ones that are good enough businesses that they're able to pay out dividends each year. So it's a very nice protection. You know that a company that pays dividends won't fall by as much when you have a bad year in the stock market. Taxes, another thing. Well, as far as if you're an individual shareholder and you receive dividends, they're taxed at this complicated rules, but you're taxed at less than if it was regular income, like a salary or a rent from a building that you own. When you have dividends between two corporations, they're tax-free. So if one corporation invests into the shares of another company and they receive dividends, they're not paying taxes at all on that. And similarly, tax-exempt investors would be, examples would be, say, nonprofits, endowments of universities, pension funds. Because a pension fund doesn't actually, say you have a $1 billion pension fund and they make a 10% return on their portfolio. So they made $100 million that year. They don't pay taxes on that $100 million at all. Where taxes are paid is the people that receive pensions. When in the future they will receive their pension check, then that's considered like a salary, so that will be taxed. But while the money is inside a pension fund, or similarly, while the money is inside an RSP, it's not taxed each year. Asymmetric information is about the people running the company understand more about the health of the company because they're there every day than somebody that just invests and looks at the financial statement once a quarter. So dividend payments are a way to convey information in the market, to the market, sorry. If a company is increasing its dividend, that's a very positive sign that the management believes that the business is doing well enough that they're going to be able to continue paying that. If they've been paying a 5-cent dividend per share per quarter, and they raise that, say, to 7 cents or 10 cents, that signals then the management is quite confident that the business is growing, the cash flows are stable enough that they can maintain this higher dividend payment into the future. It's a sign of a very healthy company. Very good cash flows, stable cash flows. The opposite is a dividend decrease. It's really like, what would I say? It's like, people look at that as one of the worst things a company can do. If a company has been paying a dividend each quarter for 5 years, 10 years, 50 years, 100 years, and then all of a sudden they say, oh, we don't have enough money to pay our dividend anymore, that's a pretty bad sign that the business has turned for the worse. And I'm telling you, like, if you ever want to see a stock go down, whenever a company announces that they're going to reduce or stop the dividend, I'm telling you, the stock just goes right through the floor. Yeah.
Isn't it just as bad if they pay out too high of dividend?
Yeah. What happens is if you pay out too high, then if you have a company that's stable, you can pay a high dividend because you don't need any money to. Basically, for the company to maintain its current cash flow, it needs to retain enough of the profits to do what's called the sustaining capital reinvestment. So, I have equipment, and, equipment lasts 5, 10 years, whatever, but, I have a factory. So each year, I have a certain amount of my machines that I have to replace because they're at the end of their life. So a company that's mature and not growing should be able to pay the dividend up to have just enough for that sustaining capital reinvestment. If you're paying out a high dividend, it also means that the company has stopped growing. Because if you had investment opportunities that you could put money into to grow the business, then you would do that. Once you start to pay a higher dividend, it's a sign that you just don't have better things to do with the money inside the company, so you're better to return it to the shareholders. And that's a problem that a lot of companies don't get. They try to grow forever, but there are some industries, some companies, some situations where you just have to accept that the business has gotten to the point where, if you're Walmart and you're already selling to almost everybody on, in the U.S. and almost everybody on Earth, then there's no point of keeping all the money you make to reinvest in the company because you're already saturated. You're already like, a certain percentage of GDP. You're not gonna, double the amount that you're selling already. So I don't know. Am I answering your question?
Yeah.
Good. So I talked about this a little bit earlier called the clientele effect. Because of the different reasons that I explained, not just from the point of view of the company, but more from the point of view of the investors, there are some reasons why some investors do prefer a low payout. They're long-term investors. They're looking more for capital gains. And there are other investors in the market that have a reason to want a high payout. There are investors that are, want more current income as opposed to future capital gain. The clientele effect says that it really doesn't matter because of this reason. If you change the dividend policy that you have, say you're going from a low payout to a high payout, what's going to happen is, say if I'm going from a low payout to a high payout, the investors that preferred a low payout, that were a long-term capital gains investor, will sell your stock to go somewhere else, but then you're going to attract the other type of investors, the ones that are looking more for current income and current dividends. So the clientele, these are what we call clienteles. You have these different groups. So you might have, say, certain investment funds that will say, we will not invest into companies that don't pay a dividend. So once you start paying a dividend, all these funds are going to start to put money, are going to start to buy your shares. But now, the other investors that preferred high growth, high capital gain, now all of a sudden they don't want it. So sorry, I think I went a little bit too far for the break. Yeah, let me do this one last slide and then we'll take a break. And it's a nice logical spot to. I've essentially been explaining this just now. So what do you think happens to a firm that changes its policy? What ends up happening is whatever group of investor were attracted to your shares before, now you will attract different types of investors. And that's what's called the clientele effect. Okay, let's continue. So really, not even that difficult, but the only really tough part of this course is what's called residual dividends. And that's a dividend policy that's based on what can you invest in? What do you need money to invest in? And then whatever's left, you pay whatever that remainder is. So first, you determine what you need in capital and investments for the upcoming year. You determine what you want your capital structure to be at. So remember, capital structure is the mix of debt and equity that your assets are financed with. So what would happen is, if as new capital investments came up, all you ever did is got bank loans for it, then over time your debt to equity ratio would go up. You would have more and more debt because whenever you made new investments, the money for the capital for those new investments would come from debt. The key point to understand here is this. I think it works better with a picture. So let's look at this example. You need $5 million in capital investment. So you want to keep a target capital structure of 2/3, meaning that one plus 2/3 is equal to 5/3, which is 3/5, which is 60%. So I want to maintain a capital structure where 60% of my assets are financed with equity. My net income is $4 million. So what I'm going to do is out of that $5 million, if I want to maintain the capital structure that I have, then what I want to do, that's the key point to understand here, is I want new investments to be financed using the same percentage of debt and equity that I already have. So in a residual dividend policy, the debt part of the capital structure for the debt part for the new investment comes from new debt that you will have. Either you sell new bonds or you get a bank loan, or maybe it's financed by the company selling the equipment. The equity, and that's the key point, the equity comes from part of the net income. Remember that retained earnings are part of the equity account. And so out of that $5 million, if I want to finance 60% of that $5 million using equity, then that means I'm going to have $3 million of it is going to be financed with equity, and $2 million of it is going to be financed with debt. So if the capital structure of my company is 60% equity and 40% debt, and I increase my assets, and the way that I finance those new assets are using that exact same percentage, then my capital structure percent will stay constant, will stay the same. So what I do is I will have $2 million in new debt. That's where the $2 million of the $5 million comes from. For the equity part, it will come from retained earnings. So out of that $4 million, you have 3 million in retained earnings, and whatever's left, which is 1 million, becomes your residual dividend. So that's what a residual dividend policy is. It's based on what new capital investments I have, and I want to maintain the financing of those new capital investments using the same percentage of debt and equity that I had before. So the equity comes from the net income that I made. The debt comes from new debt, and whatever is left out of my net income is what gets paid in dividend. That's why it's called residual, meaning, residual, what is the residue, what is left. So looking at that, if you had so in that case, you have $1,000 in net income. So if you had nothing new to invest in, then you would pay out that full $1,000 into dividends. If you had, say, $1,000 of new investment to make, but I'm guessing in that case this is a 1/3 equity, 2/3 debt, or no, 2/3 equity, 1/3 debt capital structure. So if I had $1,000 of new investment to make, then I would take 666 of my $1,000 in net income, invested in that, and the 333 that's left I would pay out as a residual dividend. What happens is, past a certain point, I don't have, I've used up all my income from the past year for capital investments for the next year, and so I have no money left to pay out in residual dividends. What happens past that? Well, you would have to, if you want to maintain the same capital structure, you would have to go and raise new shares. So if I look at this example here, and there's a simple, it's not in the textbooks, just a formula I came up with. Well, if you look at it here, I'll just do it for this example, and I'll do it again for that. The formula is this. The residual dividends are the net income minus the weight of equity times what the investment is. But of course, the weight of equity can also be written as, using that formula, so another way to write residual dividends is net income minus investment plus 1 plus debt to equity. So in that case there, you had 4 million minus, the investment was 5 million. Well, the weight of equity was 60%, so 60% of 5 million, and you end up with the residual is 1 million. So in this next example, so the net income is $1,800. The investment is $2,000. And you want to maintain a debt to equity ratio of 0.75. So it's 1 plus the debt to equity ratio, so it's 1.75. And so you will pay out so what happens here? You take whatever 2,000 divided by 1.75. That's the equity contribution to the new capital investment. The rest of it you pay out, you raise in new debt, and then you have the residual dividend of $657.14. The next dividend policy I'm going to look at well, there's really two of them, but they're related. It's the cyclical dividend policy and the stable dividend policy. That's when you have, there's lots of businesses that have quite a bit of seasonality in them. You know, if you're a construction company and you're in Canada, the ground's frozen, 3-4 months of the year. So, you don't see a lot of construction going in the middle of January when the ground's frozen and it's snowing. It's crazy cold outside. If you're a retail store, you make most of your money around Christmas or so. If you're a golf course, not a lot of people golfing in the winter. And vice versa, if you're a ski hill, not a lot of people skiing in the summer. So you have lots of different industries where there's quite a bit of seasonality in the earnings. And so how do you pay dividends? There's two choices here. The cyclical dividend policy is where you pay a fixed percentage of earnings on each throughout the year. The stable dividend policy is where you look at what your earnings over the year are going to be, and then you flatten them out, you average them out, and then you pay the same amount each period, like each quarter or each month. So I think best let's do two examples. The first one is a cyclical dividend policy. So the dividend you're going to pay quarter 4 is going to be the payout ratio, but here you're given the retention ratio. So if the retention ratio is 40%, then the payout ratio is going to be, maybe I should spell it out. So if you keep 40% of your income, if you retain 40% of your income, then you're going to pay out 60% of your income. And the income in that quarter is 115. And so what you're going to pay is you won't pay the same amount each quarter. Each quarter, well, obviously if you have a loss, you won't pay out anything. But what you're going to do is you're going to pay 60% of 50,000 in the second quarter, and you're going to pay 60% of 175,000 in the third quarter, and you're going to pay 60% of 115,000 in the fourth quarter. So the amount of dividend goes up and down with the amount of net income. There's a fixed amount, there's a fixed percentage of the net income that's paid out, but because the net income's moving up and down, then there's also a variable amount of dividends that are paid out. The way to even this out is, in this case here, we have a company that has quarterly earnings projection, so this is what they think they're going to make over the next 4 quarters, but they want a stable dividend policy, so they don't want to pay 69,000 one quarter and like 50,000 the other quarter, and then not pay something, and then pay 15,000 and so on. They want to come up with one number that they'll pay the same each quarter. So if the company retains 60% of its earning, what is the dividend going to be for the second quarter? So first you need to average out So the net income for the year is going to be the net income for Q1 plus the net income for Q2 plus so they're going to make $3 million over the whole year. So the dividend, the total dividend paid over the whole year is going to be the payout ratio times the net income for the whole year. That's going to be 60% of 3 million, which is 1.2 million. And so the dividend for each quarter, in this case, well, Q2, so you know you're going to pay 1.2 million over the whole year, and therefore you're going to pay 300,000 each quarter. So the cyclical dividend policy has a stable payout ratio, but a variable dividend, and the stable dividend policy has a constant dividend, but a variable payout ratio, because each quarter you're going to pay 300, but you're going to be making different amounts. But this way, instead of having a different dividend paid each quarter, you're always going to pay 300 each quarter. Yeah. 1.2 divided by 4?
No, 0.16.
Oh, it's sorry. It retains 60% of its earning. So yeah, it's 40%. Oh yeah, that's a mistake I made here. Sorry, it retains 60. That was the mistake. So if the retention ratio is 60%, then the payout ratio is going to be 40%. Sorry. Thank you. What is a compromised dividend policy? That's it's another word for it is called WIFL, whatever I feel like. This is more in private companies. Yeah.
Just for the last one, if you had a loss but stable, would it count as still?
Yeah, you would subtract. What you want to do is know what your income over the whole year is going to be. So if you had a loss, then that would just, when you made your average there, it would count into that average. But then you would just flatten it out over, you would not, ignore it like you did in the previous one. You would include it in your computation of the full year income. So compromised dividend policy is just this is not something that, say, happens in public companies. This is more something that happens in private companies, where it's just sometimes it's based on, there's this cottage that I really want to buy, and so I'm going to pay a high dividend this year, or I really want to buy this boat, or I don't have any big expenses this year, so I'll just keep the money in the company and buy a new piece of equipment instead. Public companies have fairly formal approach to what the dividend policy is. For example, banks in Canada specifically say we will pay 50 we will have a payout ratio of 38% or whatever. Public companies tend to have fairly formal, fairly rigid dividend policies so that investors know what to expect. But when you're talking about private companies, all kinds of things can, like I said, whatever I feel like, either I want to keep a certain amount of debt to equity ratio, or sometimes it's based on personal consumption, like I want to buy myself this year, but I don't the next year. Sometimes it's just based on what you can invest, or some other times it's just like whatever I'm going to make, I'm going to take out half of it, and I'm going to keep half of it in the company. This is what you would call a compromised dividend policy. It's just based on just kind of judgment and the decision of the owner. But that's more typical in private companies. You don't have public companies that are just kind of making it up as they go along. Stock repurchase is a way to flow cash to shareholders instead of paying dividends. So you can have a tender offer where they'll say, the board will approve each quarter, or sometimes a repurchase will be over a long period of time. They'll say, we have $2 billion to buy back shares, and over the next quarter or over the next year. So what the company does is they look at their stock price. They'll give that contract to like an investment bank, and then based on whatever the stock price is doing, then whenever the stock price is low, then the company will use some of that money to buy back shares. That's a way a little bit to manage the stock price. But at the same time, if a company has money to buy back shares, that's a positive sign. That's a healthy company with healthy cash flow. It's well managed, so the stock should be worth more, and it should be also less volatile. Because if you have a stock that's going up and down like crazy, then what's going to happen? A company that has such a program, such a repurchase program in place, they will come in, and whenever the shares are below a certain amount, they'll tell their broker, anytime our shares, we have, $20 million, and anytime our shares are below 15, just buy them up until the amount of money that we have allocated for this quarter runs out. So that creates a kind of a floor under stock prices. These types of stocks tend to be less risky because you have that player playing in the marketplace that tends to stabilize the stock. Here's an example of a stock repurchase. So Nelson is considering a $120,000 stock repurchase. Currently, there are 10,000 shares outstanding at a market price of $30. The PE ratio is 15. What is the earnings per share after the stock purchase? So the net income, well, the net income's not giving, remember that earnings per share is earnings divided by the amount of shares that you have. But we're not given the earnings, so earnings, net income is the same thing. What is the net income? Well, it's the earnings per share before times the number of shares that you have. What are the earnings per share? It's the price of the shares divided by the earnings ratio. So that's kind of a roundabout way. This is what I would call, intermediate kind of level type of question. You're not, it's not just here's the formula, plug in the numbers, boom, boom, done. This is more of you got to think a little bit. What do I have? What do I know? And how do I get to where I want to be? Well, in this case, I want to get to the net income, but I'm not given what the earnings are, but I'm given what the price is, and I'm given what the PE ratio is. So that's how I can get to what the earnings are. And then I have the number of shares. So the price of the share is 30. The PE is 15, meaning that the earnings per share is 2. You have 10,000 shares, and so the net income is 20,000. So the number of shares after is going to be 10,000 shares minus you will do a $120,000 repurchase, and the shares are selling at $30, meaning you will buy back 4,000 shares. And so if you had 10,000 shares before and you buy back 4,000 shares, you're left with 6,000 shares. So now the EPS see, the earnings per share before was $2. But after, you still make the same amount of income. This is, what's called financial engineering, right? The actual business is not changing. It's still making 20,000. All you're doing is changing the amount of shares that 20,000 is distributed across. So in this case, it's the net income, which hasn't changed by how many shares you have afterwards. So that's 20,000. And now you have 6,000 shares. And so you have, the company is not making more money. It's still making 20,000. But now there's 6,000 shares out there instead of 10,000. So the earnings allocated to each share has gone up from 2 to 333. That's how you're returning as a company cash to shareholders, by buying back stock. The earnings per share of each stock that's left out there is higher, therefore those shares go up. So that's how you create a capital gain. The amount of net income is still the same. You reduce the amount of shares that are out there, so the shares that are out there are worth more because each one of them has the right to more income. Even though the overall income still hasn't changed at all. Let's look at a different stock repurchase. MDM has a debt to equity ratio of 0.5, but a PE ratio of 10. You have to be careful here because just so people are not confused, the E in DE ratio refers to equity, but the E in PE ratio refers to earnings. So that the E in DE and the E in PE is not the same. So first, we need to find out what is the amount of equity. If you just multiply something by 1, you still have the same thing. So you're left with so the previous one, would have been called an intermediate. This is what I would call a little bit more advanced because you gotta, figure out a way to get to what the amount of equity is, because it tells you what the debt to equity ratio is, and it tells you what the debt is, and so if you divide the debt by the debt to equity ratio, you get to what the amount of equity is. The debt is selling at par, and the shares of stock are selling at 25 a share. How many shares of stock will be outstanding after MDM completes a $25,000 share repurchase program? So the number of shares will be actually no, that's not the change in shares. That's how many shares the company has. So if the equity is worth 100,000 and the shares are trading at 25, then that means there's 4,000 shares out there. And that means that the shares you will have afterwards will be, you have 4,000 shares, and you will buy back 25,000 of those shares, $25,000 worth at $25 a share. And so you will buy back 1,000 of those 4,000 shares, and so you'll be left with 3,000 shares. Real world consideration. So stock repurchase, we talked about that, I had some questions earlier about, taxes and so on. Stock repurchase allowed the investors to decide if they want the current cash flow and the tax consequences. Essentially what stock repurchase do is they convert a dividend into a capital gain. But the investor doesn't have to realize that capital gain. Because the shares in the market, there's less shares in the market, they're worth more, but if the investor doesn't actually sell those shares that year, they don't get hit with the tax bill in that year. So the company flowed cash to the investors, but the investor that will make an unrealized capital gain, but they will not realize that capital gain and pay taxes until, years later, until they actually sell the stock. Then there's some, I won't, I put that up as a point there. I won't ask you that on an exam, but there's a complicated kind of tax concept called paid up capital in the Income Tax Act, and that has to do with things like deemed dividends. Anyway, just be aware that, there's some tax regulations. You'll get into more details into advanced tax courses. I just put it there so you know this concept of paid up capital. In Canada, because of that, it removes the tax advantage of stock repurchase over dividends. There's these situations where, if you do something, it's seen as you're trying to get around the tax law, so it's called the deemed dividend, but then it reduces the amount of what's called paid up capital. Just so you're aware, that's a concept that exists, but I won't test you on it. Just like dividends, stock repurchases are a positive signal to the market that the company, well actually in that case, it's a signal to the market that the company considers they see the price as being too low. Because what happens from the point of view of the CFO, if the stock of the company is extremely high, what should you do? You should go out there and raise new money, right? If somebody is willing to pay you, $38 a share when your share is really worth 18, that's the Facebook story, then you should just go out there and sell 1 billion shares, right? The opposite is if you see that the market is putting a much lower valuation in your shares than what you think it is, then that's a great time to use your extra cash to buy back shares because they're at a lower price, and then what you do is you end up juicing future earnings per share. A stock dividend is, we'll see in a bit when we talk about stock splits. This is 17. Yeah, I'll do stocks. Stock dividends are, instead of the company paying you, say for every share you own, say they'll give you $1 dividend. A stock dividend is for every share you own, you receive a certain amount of new shares. Another example of stock dividends, you'll see those come up sometimes in merger and acquisition deals. But if you have 100 shares and the company declares a 10%, if they declared a 10% cash dividend, then you would receive 10. Yeah.
What if the number is not that convenient? I mean, if for instance it's like you only have, let's say, 5 shares.
Shares are only sold in blocks of 100.
Get it?
Yeah, they're called board lots. Like you can't go, you can't put an order for like 57 shares. You can only put orders for multiples of 100. There's some mechanism for dealing with what are called odd lots, but it's extremely rare. People only deal with 100 shares is the minimum amount of shares you can own of a company. And you can own 100 shares, 200 shares, 300 shares, but you can't own 112.
I don't think I heard of that rule.
What?
You can own like 12 shares of a company if you want. It's a public company?
Yeah?
Yeah, you can own as many as you want.
Okay, maybe they have systems now where it deals better with these odd lots, but just most people deal with group lots of 100 anyway. Yeah, they're trying to be more accessible to very, very small investors. Like somebody wants to own like 3 shares of Apple, but you laugh, but that's worth like more than $2,000. I actually, for my daughter in her investment fund, I bought her 1 share of Apple. So, well, I had to put in $2,500. So, I just, $600 or whatever dollars that she has allocated in her, university fund for future. Yeah.
I think there's no why a person still can buy just 12 shares or 3 shares or 1 share, because if you go to a bank like Scotiabank or Bank of Montreal, they're getting so many orders in it, like Stocks like Capital, I'm sure they get thousands of requests a day that they can buy.
Break it up into small things.
Yeah. Exactly.
Yeah, but the actual exchanges deals in lots of 100. So yeah, you might be able to get what these call odd lots, but I don't really know much about that, and it might be handled just within the bank itself, not cleared through the market. So if you own 100 shares and the company declares a 10% stock dividend, then you receive 10 shares. Maybe that's how you end up having to sell these odd lots, because you receive these stock dividends. But these are actually pretty rare that you actually receive, this stock dividend. You'll see the only reason that I'm aware of things that I've heard of or seen happen is stock dividend is actually the mechanism by which stock splits are done. You'll see that in an example. I'll give you the punchline right now. If you do a 2-for-1 stock split, then what you do is on the 100 shares, you declare a 100-share dividend. And so that's how you raise your shares, say you double the number of shares out there. That's how you do a stock split. Let's look, example here. But yeah, odd lots are complicated enough that people try to stay away from them. So in this case, you have 6,500 shares. You have a 5% stock dividend, so you will declare a dividend of 325 shares. So for every 20 shares you have, you receive 1 share. So the retained earnings be after Okay, here's a nice point to take a break. So I have 8:05. You guys like 10 minutes, so we'll start again at 8:15. And let's continue. So stock splits. It's this. The purpose of doing a stock split is to have a more desirable trading price for a stock. So if you look at stocks, that have been around for a very long time, like 50 years, 100 years, like over time, what happens is the stock price goes up, and then it gets to a point where the stock price is ridiculous that nobody can even buy a single share. That's the case of Berkshire Hathaway, Berkshire Hathaway. The one share of Berkshire Hathaway is like $130,000 just for one share. So to buy a lot is, you're talking what, 13 million. Right? So, well, what they ended up doing, because he didn't want to do, Warren Buffett didn't want to do stock splits. He always wanted to keep the same price. But instead what they ended up doing is a Class B a share that's got a lower price, and that one they kind of maintain within reasonable, they have the Class A shares, which is the share that's never been split, and that one's worth, I don't know, 130,000. That could have gone like up or down. What is 300,000 now?
I think so. Something like
Yeah. So, but let's look at Apple. I'm surprised that Apple hasn't done a stock split, because once the share is up to, here's the example of my my daughter's university fund. Say if I only want to invest $300 in Apple, and how would I do it? Well, a share now is like $600 or $700, and yes, there's these odd lots, and I don't know like how that's something new that small retail brokerages have gotten better at handling. But in general, you can only buy, unless because I bought it through Scotia iTrade. Unless you go through some of these, very retail type of brokerages, you can only, the minimum amount of shares you can buy in a company is 100. So until there was these mechanisms to handle these small, what are called odd lots, if I want to buy shares in Apple, then the minimum investment would have been $70,000. So what if I have, $7,000, or what if I have $1,000 to invest? How do I do that? The purpose of stock splits, you don't actually change what the total worth of the company is. All you do is you issue the same amount of, you issue a new amount of shares, you change the amount of shares, but the overall company is worth the same. So if you do, for example, a 2-for-1 stock split, and the company before that was selling at, say, $80 a share, well, if you do a 2-for-1 stock split, the total market value of equity stays the same, but now you have twice as many shares, so each share is worth $40. Assume that these odd lot mechanisms don't exist, then now the minimum investment that you're able to make in that company is $4,000, whereas $4,000, whereas before the smallest investment you could make is $8,000. And if it's even worse than that, because you have like this discrete problem where you could buy $4,000 of that dollar, you could buy $8,000 worth of that company, or $16,000 worth of that company, or $24,000 worth of that company. But what if you're, if, in your investment fund you want to buy $10,000? Well, you can't. So the purpose of doing a stock split is it makes it easier to trade. It increases the liquidity of the stock. If you look at those, $300,000, Berkshire Hathaway shares, their volume is not very high, right? There's, it's not a million of those traded every day. So by doing that, what you increase the liquidity of the stock of your company. You make it easier for investors to buy and sell your company because you make it available in smaller chunks. You don't change the value of the company. In a certain way, you actually do, because by increasing the liquidity, the shares will bump up a little bit. So even though you do a 2-for-1 stock split, and theoretically the value of the company the total market value of the company should not change. What happens is when you do a stock split, the stock will bump up by a couple percentage because of that extra liquidity. Now you have people that, smaller investors that can buy it, whereas before they could not. Or you have a situation where, before you'd say you had an investment fund that could only buy, say, 8,000 or 16,000, but because of, say, the 2-for-1 stock split, they're now able to buy 12,000. And so that creates a little bit of marginal buying demand for the stock, and that does create a little bit of, a few percentage gain, even though in reality the total value of the equity should not change. Because of that extra liquidity, it does raises, because it makes it more liquid and easier for more people to buy, or for the people that buy to buy a little more because they can buy up to their number. To say you have an investment fund that says we won't have more than 5% of our fund in that per company, or we won't have more than 1% of our fund into one company. Well, they can only buy up to, before they could only buy up to 8,000, but all of a sudden now they can buy up to 12. You do create that extra buying demand. So let's look at an example of stock split here. So before you had 420,000 was the market value, and you had 6,000 shares, and so each share was worth $70. If you do a 2-for-1 stock split, then you will go for what happens. What the X for Y stock split means is 2-for-1 means you will have 2 shares after for every share you had before. So that would be an example of 100% stock dividend, right? For every share that exists, everybody receives 1 share. So you will go from 6,000 shares to 12,000 shares. But the total market value, ignore like that little speech I gave you about liquidity, but now the shares are worth less, half, but there's twice as many out there. So that's what a stock split is. So this is the summary. Dividend policy is irrelevant if you ignore taxes or other imperfections like liquidity, increased liquidity through a stock split. Individual income tax rates and flotation costs would favor low dividend payout. Corporate investors and tax-exempt investors. So examples of tax-exempt investors would be people that invest in our RSPs. Also would be non-profit organizations, so like endowments, like Carleton's like scholarship endowment funds. Pension funds, because it's not the pension funds that's taxed. It's when they pay out a pension check that becomes income that's taxed to the pension holder. So those are examples of people that prefer a high payout because they're not paying taxes on dividend. The clientele effect means that when a corporation changes its dividend policy, it will some of the investors that they had before will go away, but new investors will come in, and so you'll end up attracting a different clientele. But that's actually what's happening. the price doesn't change that much because the people that run away are balanced by the new people that come in. Residual dividend policy have unstable dividends, but they're based on whatever your capital investment needs are in that given year. And stock repurchases are similar to cash dividends, but for tax reasons, sometimes they make more sense. So I think I'm at my more examples. So remember that you can, I'll take a 5-minute break here. You can leave if you want, and then I just have a couple more examples. I'll have, yeah, I got plenty of time to do more examples tonight. All right, so I have more examples. So like I said, there's no new material. It's just more that's just a way that I've explained that before. More examples is a way that's kind of my slush fund of time, because I never quite know, how much time I'm going to use for each class. So I put more examples so that if I'm short on time, then I just get up to this point for up to 8:55. Otherwise, then I have a little bit more to do for the rest. So let's look at an ex-dividend problem. Mark bought 100 shares. So Mark bought 100 shares of XYZ stock on January 5th at $12.05 per share. XYZ declared a 30-cent per share dividend on February 24th with a record date of March 24th and a payment date of April 15th. Mark sold his 100 shares on March 22 at a price of $13.22. How much did Mark make on his investment? So there's two components to his return. There's a capital gain because he bought them at he bought the shares at $12.05 and sold it at $13.22. But there's also a dividend. But we got to check, does he get paid the dividend? The record date is March 24th. And he sold them on March 22nd. Friday. Oh yeah, so it's the Friday. If it was, if it would have been, say, Thursday, March 24th, and he bought them on Tuesday, March 22nd, he wouldn't have gotten a dividend. But in this case, March 22nd, wait a second. Sold his 100 share on March 22nd at a price of 22. In the answer in the book, it does say that he keeps them, but if he sold them on March 22nd, the record date is Friday, March 24th. He shouldn't have. There's a mistake there. I'm going to have to fix it. If the record date is March 20. See, if he sold them on March 22nd, then he didn't own them at the end of business on March 22nd, which is when the so that's not. Can somebody calculate this for me? What's 1322 minus 1205 times 100? Yeah, the some of the questions in the textbook question bank sometimes are not have little mistakes in them. That's a mistake right there, because if he sold his shares on 22nd, that was the ex-dividend date. That if he had sold them on March 23rd, he would have received the dividends. But because he sold them on March 22nd, he shouldn't have received the dividend. There's an example of homemade dividend. Okay, so this is, so now we have a residual dividend policy question. So the equity here, remember that what we got to figure out for the residual dividend policy question is we got to figure out what is the weight of equity. So we're given the number of shares and the market price, so that's how we get what the equity of the business is, the market value. So you got 25,000 shares at $20. So the market value of equity is 500,000. And so the weight of equity, and you also have 500,000 in outstanding debt. So the weight of equity is a half, meaning that the residual dividend is going to be you have 100,000 in dividends, net income, and you're going to keep half of the retained earnings. You're going to finance half of the 120,000 from retained earnings. So the part of net income that's left is 40,000. So you have an investment of 120,000. So since you want to maintain a weight of equity of a half, 60,000 of that 120 is going to come from retained earnings. And so since you made 100,000, you have 40 left that you give out, and then you will also raise 60,000 in new debt. Now you got to be careful. It doesn't say what are the residual dividends. It says what is the residual dividend per share. So first you find the residual dividend for the whole thing, and then you just divide it by the number of shares. Residual RDEPS is residual dividend per share. That's the residual dividends by how many shares you got, which is 40,000 divided by 25,000 shares. And so it's $1.60. Okay, stock repurchase type of question. So the amount of shares that you will have after is what you start with, which is 240. And then you have 1,040. What does it say? And what is the price per share? Well, if that's what, $20? 2 times, yeah. So if the, where does it say 4,800? Where did I get that from? The firm is going to pay out 1,040. Equity is worth 4,800, and you have 240 shares. So each one of those shares is worth $20. And so if you buy back 1,040 of shares, you're going to be left with 188. So you start with 240 shares, you buy back $1,040 worth, you're left with 188. And so the earnings per share after are going to be, the net income's not going to change, but you now have a different amount of shares. So the net income is still going to be 410. But now that 410 is split across 188 shares. And so the earnings per share are 218. So now we have, that's another stock repurchase example. So what is the price today? It's the total market value of the equity by the amount of shares you got. So you got 91,200. Equity is worth 91,200. And you have 1,200 shares. And so each share is worth $76. And so the amount of shares you'll have afterwards, if you start with 1,200 shares, and you buy back $4,560 worth, and each one is worth 76, you'll end up with 11 and 40. So what you're buying, about 60 shares. So last example of the night. So the market value is not going to change. And so if you have 15,000 shares before, and you do a 3-for-2 stock split, what you're going to have is 1.5 times the number of shares you started with. So that's 22,500. Right, that's equal to 15,000 multiplied by 1.5, which is really, that's the same as 3 divided by 2. And so the shares are going to go from 36 to 24. That's your answer. All right, that's it for tonight. I will see you next Tuesday. Remember quiz 3 at the beginning of class on chapter 17.